All right, all three major averages clocking in 3 straight winning weeks. This comes after a week of solid gains as investors make their bets on the Fed's next rate decisions. Here with how investors should be eyeing future asset allocation, we turn to GenTrust principal Matt Kishlansky. So Matt, thank you for joining us today. Let's just start with this market, Matt. I mean, stocks have been on a tear this month. I'm interested to get your perspective on whether you think the rally continues here, Matt.
Yeah, thanks for having me back. I don't think there's any way to ignore the pretty wild emotional swings that the equity market has gone through over the last 6 months. From the summer going into the fall, you started with the market you could almost hear the equity market chanting, AI, AI. And that suddenly turned into I, as we got into the end of the summer and the beginning of the fall. And then over the last few weeks, it's kind of upgraded back towards, hey. And I think as you look at that mood swing that the equity markets and their investors have been going through, I think it's easier to see it if you zoom out and appreciate that investors are coping with the realization that we're going to have rates higher for longer by kind of experiencing the 5 classic stages of grief. We started in this summer with stage 1, denial, despite all the evidence that we would have higher discount rates, despite a pretty tepid Q1, Q2 earnings season that was all about cost management and not about growth. Investors put the S&P price to earnings multiple from 15 all the way up to 20 until abruptly we entered stage 2, which is anger. And we saw a lot of reversal in those gains, particularly among the so-called Magnificent Seven mega cap stocks that had fueled so much of the warm weather rally. I'd argue that starting about 3 weeks ago, we entered into phase 3, which is bargaining. In essence, the market came out and said, okay, fine. I don't need to keep all the froth that I built into some names like Tesla, maybe Google, but I definitely need to keep the froth in some of my other names, NVIDIA, Microsoft, Apple. And so what you've seen over the last 3 weeks has been a close to 10% rally in the S&P, and that's pushed forward earnings, one-year forward earnings in the S&P. I think at one point this week we touched 19. And again, that's all on the back of the Q3 earnings season, which was modest and much like the front half of the year was all about cost management and not about revenue growth and growth in general. And so I think investors, to answer your question, they really have to ask themselves, how much longer can companies continue to either pass on costs to consumers or reduce spending on things like payroll, inventory, R&D? And I think that question gets into starker relief when you look forward at a 19 times forward multiple and infer from that earnings yields will be at or below what investors can get in overnight cash yields or in easily obtainable fixed income yields. So the question here is are we about to enter into stage 4 of the classic stages of grieving, which is depression? And does that mean when we stay here, we stagnate at this price range for the foreseeable future until companies can reliably prove that they can beat these modest growth targets that they've set for themselves? Or do we see PE ratios come back down to a low enough level that investors can reach stage 5 of the grieving cycle, which is acceptance?
Matt, you're the pro here. What do you think?
I think people are really trying to get a handle on the volatility on both sides of the inflation and rate coin. And I think that's really where we see a divergence of opinion. I think some people, again, see that 19 or 20 multiple and think we need to come back down, particularly given the headwinds we're potentially facing in 2024 with either somewhere between a soft landing and a recession. I think that's where GenTrust comes out. We are a little bit underweight equities. There are pockets within equities that we like, but we'd rather be underweight with our allocation being towards things that are long rate stabilization. But we, as long-term investors, still view these multiples as a bit rich.
And Matt, when you say there are pockets in the equity market you like, what are some of those pockets, Matt? What are some sectors you would still find attractive at these levels?
Yeah, absolutely. We continue to think that there is a slow but very persistent trickle of federal funding coming towards infrastructure. And so there are a number of names that we like and within the infrastructure sector that we think it's a slow grind, but the money is being dispersed. It's been funded by Congress and will continue to flow through. There are other areas that we like within energy, both traditional old school energy as well as some of the newer, cleaner energy areas. And I think what's important for investors to realize is you can have it both ways in energy. I think you can see short and medium term profits from traditional sources, but also appreciate that on the long term, there is a transition coming to clean energy, and there's profits to be had in both camps.
And Matt, what about on the fixed income side? How do you think folks should be positioned right now?
Well, I think that's a tricky question. I think, again, there's two camps. Some people want to have a heavy overweight to cash. Their view is they still see a cloudy inflation picture, volatile inflation prints, and they're concerned that long-term rates can continue to go up materially above 5%. I think at GenTrust, we are more interested in picking up duration here. We recently took all our profits on tips trades that we had that went, as inflation picture has gotten a little bit clearer, we took a significant amount of profit there to grab longer term duration. We view the insurance value in fixed income now to be stronger than it's been in quite some time. And we're happy to grab and hold yield. I think some investors, the challenge they're facing is they have a lot of the same way risk. If you're sitting on a lot of equities and a lot of cash, if you hit a deflationary bump in the road, which to a large extent is by definition something that nobody expects, you're going to see overnight yields plummet and you're going to see your equity portfolio plummet at the same time. So for the first time, grabbing duration can give you some insurance there, and it's certainly attractive to longer term investors.
All right, Matt Kishlansky, thanks so much. Appreciate it. Have a great weekend.
Absolutely. Thank you.